Good afternoon. I'm John Mousseau. I'm the CEO and President of Cumberland Advisors, as well as the Director of Fixed Income. It's Wednesday afternoon, March 18th at the close, and I wanted to give you a little bit of an update on the bond markets, and my colleague Matt McAleer was going to give you an update on the equity markets. With all the turmoil out there, we thought something in the middle of the week was very worthwhile. We have seen great upheaval in the bond markets. It started over a week ago when you saw Treasury bond prices spiking because of Saudis buying of oil and buying Treasury bonds. That in turn affected all of the bond dealers who no longer could hedge with Treasury bonds because they would have lost their shirts. And so they withdrew from bidding on bonds, things like corporates and Munis and mortgages, etc. So we started to see yields rise on those bonds. The stock market, which we've seen the carnage, and Matt will talk about, that caused people to sell almost everything that wasn't a Treasury. Munis, bond funds, as we see REITs, commodities, etc., were all selling because people wanted cash. And by the end of the week and continuing, now they were also selling Treasury bonds. What are we doing about it? What we're doing about it is we're looking at this opportunistically. We're fairly short duration going into this mess, and the unraveling that we have seen has shown us some extraordinary bond values out there that we haven't seen in well over a year. So whereas a week ago you were looking at almost all municipal bonds with 1 or 2% type yields, it has moved up 150 to 200 basis points in some cases, where we're able to buy 3% yields, in some cases close to 4% yields on AA plus type paper in Munis. That really has nothing to do with credit. You need to be careful on credit. The things that we worry about are things that you might have looked for as an essential service bond before, but through the prism of the virus, you don't think of the essentiality of that service anymore, like a bond backed by subway fares in New York or an airport, things of that nature. We really don't want to own those, but we want to own very high-grade bonds that have really been thrown under the bus by the selling that's gone on. So what we're trying to do is pick up yield that we haven't seen in over a year and trying to extend durations to lock that in and trying to take advantage of the fear that we've seen out there. We've gone through these cycles before. We haven't seen it in this fast a time frame, and clearly what's been going on with the virus and its effects on all markets has created some of this gapping effect that's gone on there. We're encouraging people that have had money on the sidelines for bonds that now is a very propitious time to start putting some of that to work. And it's not only just, in the long end, everywhere it's cheap. So you think about a long Treasury bond at a 175, and you're buying long municipal bonds at 3.5, in some cases close to 4. I don't need to do those yield ratios for you. So what we think is over time that gap narrows, and we think the total return on munis can be quite good from these levels when things settle down. We know there's a lot of cross currents out there. There's going to be a lot of fiscal spending coming. We know, and Matt will talk about it, this equity market will find a floor here at some point. Right now it's fear and panic driving everything. But I want you to know, as a total return bond manager, we are now moving to take advantage of what we see as an extremely oversold situation. Thanks a lot.
Hi, Matt McAleer. Just after the close here on March 18th, John gave a quick update of what he's seeing in fixed income. Remember, all asset classes feed on each other and speak to each other, whether it's fixed income, commodities, currencies, equities. So it's important for us as a firm and for investors and traders to really keep a pulse on those asset classes and how they're affecting each other. John mentioned that he feels, and I happen to agree with him, that until we can get some real back and forth liquidity in the bond market, that the equity market will continue to struggle. We don't know where different levels end up being carved out on indexes, on stocks, on certain sectors and industries. Have to be careful of an extension of a business shutdown and how it affects different sectors, industries, companies. Obviously, you're seeing tremendous panic in the markets. Some of our options readings that we look at through the put-call ratios that I mention on here at times have been through the roof. I think 5 of the last 7 days have been through 1 on the equity-only put-call ratio. Back in '08, on a couple different occasions, it only took 2 times through 1 to spur a rally. So you're seeing real fear, real panic. It's understandable. This is an unknown virus to many of us. People have thoughts, ideas on how it can be contained. We'll see. Certainly, I reiterate, and in speaking to clients and other advisors, if you're bidding in this market, have your set of go-to names and be bidding below the market. Let this volatility work for you. Breakouts to the upside are going to be tough. You have so much overhanging supply here that you're going to have selling into that strength. That's what we're seeing on these short rallies. People able to say, take a breath and sell into it. Have to sit below the market if you're a bidder and buyer. And by the way, we will at some point look back at some of these valuations. I know it's difficult to see that today, but you're getting such dislocations day to day of 8 and 10 and 15% moves in some securities that are bulletproof from a balance sheet standpoint and have a business plan that, while near-term affected, may actually benefit and drive growth going forward. Don't forget, we can't ignore that once we can get some of these liquidity scenarios worked out, there's going to be an awful lot of financial liquidity backing in this market. We've seen what that did in the past. Certainly doesn't mean that the past is a duplicate of right now. And what I'm talking about is the liquidity that was pushed into the market in '08, '09, and so forth, and where the market went from there. I often say the market's like a snowflake. The market may look the same, but up close it's very different each time. '98 was different with currency headaches and long-term capital management. 2001 was different with 9/11 and valuations pre-9/11, although they had come off, still quite extended. 2008 into 2009 was different with banks with broken balance sheets, needed government bailouts. Our risk here is that what seems like an event-driven sell-off, this nasty sell-off, becomes more than that. The longer it goes, the more of a fiscal problem we start having. Remember, cities have to collect debt. Companies have to be able to operate. So those are things we're looking at, things we have to be aware of, taking it day by day. Here in the office working, using smart spacing techniques. We've been isolating at home. I hope everybody's doing that, because the quickest time to containment is the quickest period of companies being able to start forecasting their needs. So again, Wednesday after the close, we'll be back with you on Friday. Have a great day. Clients, friends, if we're not getting to you on the phone, understand things that we've been jumping back and forth. Please reach out. We welcome and encourage the phone calls. Thank you.